Hi everybody, welcome back to the channel, and today we're talking about the Global X NASDAQ 100 Covered Call ETF. Now this was a popularized ETF like back in 2020 and even before then. In fact, this ETF has been around since roughly 2013. I think it was actually 2013 when this actually came out for good. So $25 back then. As you'll see, the main problem with this ETF, and I'm not going to spend this entire video talking about the negative of the fact that the net asset value has depreciated in recent years, as is evident from the chart, right? So we know that the net asset value is going down. So there's obviously some kind of trade-off going on here. So we have a large dividend, right, of 11.65%, but we're down 29% since this ETF came into inception. So let's take a closer look at this. We have an ETF that is focused on covered calls. Now, if you're unfamiliar with covered calls, let's say you're brand new to the covered call strategy, a simple example is you have 100 shares of stock. It always involves at least 100 shares of stock. Let's say XYZ is at $50 a share right now. You own 100 shares and you sell a call option at, let's say, a strike price of $55 that expires on X day. So let's say, in this case, July 14th, or just a random date I'm throwing out there. If we assume about a month from now, as I'm making this video, July 14th, we have basically you're selling a covered call, you're collecting the premium, and if the stock rises above $55 a share, then you lose out on any additional upside. So that's the downside, right? And as you'll see, that's been pretty consistent. So as we've seen in recent months, this ETF has participated in some of the upside of the S&P 500, because what we're looking at here, or I should say the NASDAQ. So if we look at the beta, okay, first of all, look at this right here. This is a measure against the S&P 500. So this ETF is much less volatile than the S&P 500. At a 0.66, anything over 1 will be more volatile than the S&P 500, and anything less than 1 is viewed as less volatile. So we have an ETF that's less volatile. We have an ETF, as implied by the name, the Global X NASDAQ 100 Covered Call ETF, is essentially selling covered calls or implementing a covered call strategy against the NASDAQ 100 index. That being said, if we look at the actual NASDAQ 100 index, we can see that it's up over the last year. I mean, I would argue we're in a pretty good bull market right now. Most analysts would. We're up 33% in the last year. QYLD, on the other hand, is down 0.06%. So you see the dilemma. You're getting a large monthly dividend, and it's been like that ever since this ETF came out. So that is one thing I will give QYLD. If you're a dividend investor, you're looking at retirement solutions, you're looking at income, you don't really care about principal, you don't care about inflation, maintaining your purchasing power in terms of your finance, let's say your portfolio, and your overall net worth, but you're just looking at getting those monthly distributions to help pay your bills in retirement, I would argue this ETF could be a solution. Obviously, depending on your risk tolerance, investing goals, and how much you have to invest, what your monthly expenses are, that's where a financial planner might come in, financial advisor, consultant, somebody who can actually take a look at your portfolio and say, hey, maybe this ETF is a good solution for you based upon your risk tolerance, investing goals, etc. With that being said, you'll see that since this ETF came out in 2014, right? 25 cents starting with that first dividend. Have we really benefited from any kind of inflation? If we look at, for example, like 10 years of inflation essentially, right? So it's 2024. We're going back to the same month. It's June. Let's start in, June of 2020 or 2014, sorry. At 21 cents for a dividend. And since then, we've had some dividends in the 20 cents, 17. Here's another 21 cent dividend, another 24 cent or 21 cent. You'll see that we have a lot of dividends now that are in the teens. It seems like they're paying actually less than they were previously. The last dividend that we saw that was above 20 cents was in 2022. So it seems like you're actually getting less of a distribution. Now, that also comes with the fact that since 2022, we can look at the longer term chart and we can see that the share price is actually down. So that would probably make sense. You might be getting roughly the same dividend yield, but the share price is actually down. Let's say from $22, $23 a share in 21 all the way, down here. So meanwhile, stocks are hitting all-time highs. The NASDAQ, New York Stock Exchange, all these indexes are hitting all-time highs, and you're losing money on your principal. And your dividends have actually gone down despite the fact that inflation has gone up. Now, you could argue that you essentially could dollar cost average and maybe just keep on reinvesting dividends if you're going to invest in an ETF like this. That's a possibility. It's also a possibility that you're at the stage where you just don't care anymore and you just want to use this to kind of get a monthly paycheck. But that is I would say the principal depreciation, or the fact that your net asset value is going down over time, that's a very strong consideration, especially with inflation, especially with the fact that the markets are pretty much at all-time highs and you're not really benefiting from any of that upside, right? So that's one of the major drawbacks to an ETF like this. And I would say, obviously, it's like the largest drawback. So if you think about a typical covered call strategy, you have, let's say, an out-of-the-money covered call. You bought the stock at 50, you own 100 shares. You sell the covered call at $55 a share. Now the stock's trading at 60. Your shares are called away at 55. You don't benefit in any additional upside. Now you're stuck actually taking a loss on your principal because you're having to buy back the same shares at a higher price, assuming you were to continue buying back the same shares or the same index. Same kind of problem QYLD has, I think, in terms of that net asset value continuing to go down over time. So with that being said, I would argue that this type of ETF is for a specific investor. It's not for an investor who cares about maintaining their principal over the long term. Like I said, with all the inflation we've had, and you look at the QQQ, the Invesco QQQ Trust, which basically represents the NASDAQ, we're up 32% over the last 5 years. If you would have just held done nothing through all the fear. I mean, this looks like a blip in the chart now, right? So I remember when the bull market happened in 22, we peaked off roughly at 14,000 for the NASDAQ, and ever since then we've just been going up and up. And the question is, like, when does this bull market actually end? I mean, it's kind of been a bear market, right, in 22, and it's just one thing to consider, because obviously if you're interested in growth and you're interested in maintaining your purchasing power over the long term, perhaps an ETF like this is not the best solution. But if you're looking for consistent monthly dividends in retirement to help pay your bills, to just kind of get by, and let's say you have a 20-year or even less 10-year time horizon, and you just want to kind of diversify your portfolio and throw a portion of your portfolio into this ETF, then perhaps this could be a solution for you. Let me know what you guys think in the comments down below. I find this ETF interesting because one major benefit of this, those monthly distributions are consistent. I mean, you're going to get those distributions. If you look back at this history, you will not miss one single month where they have not paid a dividend, right? So let me know what you guys think in the comments down below. I'd love to hear your thoughts. Thanks so much for tuning in, guys. If you want to support this channel, consider doing so for $2.99 a month. It's a great way to, support this channel. It really is. And if you like my content, it would mean the world to, just get a little bit of love from you guys every now and then. We already had our first subscriber. Thank you so much for that. They had donated like $2 or $3. Thank you so much for that, guys. Because I plan to keep all this content 100% free. I don't see any reason why people would charge an arm and a leg like $1,000 for a course or something these days, especially with the internet and AI and all this stuff. This content should be free, but I basically thrive on donations, right? So any kind of donations that come my way, it's monetized through Google AdSense, and it just comes every single month. And that is if you appreciate the content and you actually made it this far. Thank you so much for everybody who has. And with that being said, guys, God bless. Take care. Thanks so much once again, and we'll see you in the next video. Take care.